To me, that's a no-brainer. That's 35 times the return over here. Now, what happens if interest rates go up? What happens if the Fed gets their head out of their you-know-what and starts actually raising interest rates and doing what they need to control inflation and to do what's right long-term for our economy and stop playing politics? Well, what will happen is the dividend rates will go up. And the reason that is because you look at a lot of the investments, and this is the reason I'm showing this graph, a lot of the investments, the underlying investments in whole life insurance general accounts are tied to the 10-year treasury. Hey, what's going on, cash flow hackers? It's Chris with Life 180. And for this video, I want to talk to you about how whole life insurance is in fact a natural hedge against long-term inflation. Now, we obviously live in a world with Jerome Powell and the craziness that's going on in the Federal Reserve and with 7% inflation right now. And I think the new numbers are coming out relatively soon. God only knows where the inflation numbers are going to go. But here's what I can say is that inflation is real. The government's done a great job about kind of suppressing inflation, or at least the inflationary numbers. But the reality is we've printed trillions and trillions of dollars over the past couple of years with COVID, with all the money that's been printed, with all of the monetary policies, with everything that's happened from the government, from the Fed, from the money printing, everything. It has been just hyperinflationary environmental, right? Like I'm not saying it's going to be hyperinflation, but it may be, who knows, right? So we live in this space. We have 7% inflation. We have a 0% practically federal funds rate right now, depending on when you're watching this. And so what that means is your money is getting devalued every single year by 7%. If you understand the rule of 72, you basically take 72 and you divide it by the rate of inflation, so you go 72 divided by 7, and that's how long it is until the power, the purchasing power of your money is cut in half. Meaning, if something costs $100,000 right now, in 7.2 years, basically, it's going to cost $200,000 for those same things. So your money is becoming worth less and less and less, and that is why the U.S. dollar has lost 98% of its purchasing power since the institution of the Federal Reserve in 1913. So now I'm getting off my soapbox a little bit. This is the importance of why you need to have your money in an account that is hedged against inflation. The challenge is right now in this world, once again, you have two choices to make. You can either keep your money safe. This is how most people think. I can either keep my money safe in a savings account and earn 0.1% and essentially lose money to inflation, or I can put money in investments and take risk, right? That's just, and that risk, my money is going to go up. But think about it. I need to get a 7% rate of return this last year just to keep my accounts up to par with inflation to not lose purchasing power. So this is what people need to understand is it's not a matter of how much money do you have. It's a matter of what will that money do for you. And that's the big role inflation plays, and this is why having a safe place for inflation, in a safe place where your money is actually hedged against inflation instead of a bank account is so important. And this is why I love whole life insurance. And if people would understand this, I think every single person in the world would have a whole life insurance policy like this. So what I want to do, and what I'm going to do is I'm going to do a split screen here, and I'm going to show an image of a dividend scale from a life insurance company that I like. It's Lafayette Life Insurance Company. And what this does is it shows since 1991, you can see the red line there, which is the Lafayette Life dividend scale and interest rate. And then next to it, you can see the 10-year treasury constant maturity rate, right? And so while that isn't the actual inflation rate, if you go back through history and you look at the inflation rates year by year from 91 to 2020, and then you look at the dividend rates in that red line, it is very, very obvious that over the long run, whole life insurance is going to outpace the long-term inflation numbers. Now, one of the kickbacks that I get from people sometimes who are against whole life insurance is the fact that they say, well, I had a whole life insurance policy in 2000, I bought it in 2000. Or let's just say they bought it in 1993, just to work with the graph here. In 1993, I bought it and it had a 10% dividend rate. And you know what? When I looked at the current illustration on that dividend, when I bought my whole life policy, and then I look at the actual returns inside of that policy right now in 2020, it has not performed as well as it was illustrated. And you can see that the reason why is because from 1981 to right now, we've lived in a declining interest rate environment. And so in a declining interest rate environment, you are in a situation where there is pressure on dividends, and the illustrations that are done on the current rates are based on the current rates. Right now, we're at 5.2% for this company. It is the lowest dividend rate they've ever had because we are at the lowest long-term interest rates that we've ever had. And so what works in a declining interest rate environment as far as investments and the best strategy is not going to work in an increasing interest rate environment. And so I can tell you right now that I can guarantee the next 40 years are not going to look like the last 40 years where we had a declining environment. We're either going to be a flat environment or at some point in time, something's going to tip and interest rates are going to go up. And when they go up, what's going to happen is the performance in a whole life policy is going to actually outperform the current rates. That is why I think it's really important to understand. And so when you look at, as in this scale, you can't really see it right here, but what I can tell you is that in 1991, when interest rates, the dividend rate here was 10%, the inflation rate in the 90s was in about the 4% range, right? So this whole decade, even though the dividend rates have been dropping, the CPI, the consumer price index, and inflation was much lower. So your money is growing. Now, what's going to happen here 2022 moving forward, you have a 5.2% dividend rate. So everybody's like, oh, well, your whole life policy is only going to earn 4% long term. Maybe the real internal rate of return of the policy as illustrated right now is 3.5%, let's say. That may be the case for a 20-year internal rate of return, but let me ask you this. What is your alternative for safe, liquid, accessible capital? You can keep it in a savings account, earning 0.1%, or you can put it in a whole life policy, earning 3.5% long term. To me, that's a no-brainer. That's 35 times the return over here. Now, what happens if interest rates go up? What happens if the Fed gets their head out of their you-know-what and starts actually raising interest rates and doing what they need to control inflation and to do what's right long-term for our economy and stop playing politics? Well, what will happen is the dividend rates will go up. And the reason that is because you look at a lot of the investments, and this is the reason I'm showing this graph, a lot of the investments, the underlying investments in whole life insurance general accounts are tied to the 10-year treasury. And so when you look at that, there's a lag. And so as the returns in those go up, so too will the dividends in the whole life insurance policies. Now, I'm really simplifying it. There's more to it than that. But ultimately, at the end of the day, it kind of boils down to the fact that whole life insurance companies are masters at managing risk long term. You're not going to meet another company, in another industry around the world that can manage risk better. They've been doing this for almost 200 years. They've managed risk and been solvent and paid dividends every single year since before the Civil War. So think about that. While thousands of other banks have failed because of over leverage and irresponsibility, and they have to have the FDIC, these mutually held life insurance companies are financial fortresses that have been around for literally since before the Civil War. And that's why I say this is the absolute reason that everybody should have one of these as the financial foundation of their life, because when you really look at the benefits, it's the biggest no-brainer in the world. And when you look at this, I think it really helps people to understand. Now, once again, this is just my opinion, right? In where I see the world going. But if you are in alignment with me and you believe that, hey, I believe that interest rates have to go up. I believe that over the next 20 years, we can't remain at a 0% federal funds rate. I believe that at some point in time, something's going to have to give, and we're going to have to do the responsible thing and start incentivizing people to save in safe accounts instead of taking all this risk in Wall Street, right? That the principles of good, solvent financial strategy is so out of whack at this point in time. And we have to get off the drugs, get off the high of this cheap money and money printing and taking all this risk in Wall Street. And we got to get back to good, solid financial practices. And the reality is whole life insurance will benefit as we hit that tipping point. And what I know to be true, and I'm telling you this, is I think a lot of people are in alignment with me on this and saying, I don't think we're far from a correction. We're 12 years into the greatest bull run that we've had since the Great Depression, if not even before that, right? And with that said, that tells me that investing in markets right now is hyper risky in the stock market. Like, why would you invest in something that's at an all-time high? Like, the relative upside from where we are now compared to the downside, the risk reward is just out of whack, in my opinion. So what I'm saying is, by putting money into an account like this, when you look at this graph and you start looking at it like, ooh, I could buy low and ride the upside, I'm a big believer that you have to look at opportunity in a way of like, what's my upside, what's my downside, and can I live with the downside? Right now, my opinion is where we are with dividend rates and with the returns in whole life insurance on the current side, while there's no guarantees behind them, like, and I can't say that they'll get better, but my personal belief is that they will get better, that life insurance companies, while they've built a reputation of underperforming their illustrated rates because of the graph that you're looking at right here, as interest rates go up, insurance companies are going to garner more trust, more everything. Even though I would say that it's not a bad thing. They're still great accounts, even though they underperformed. But once again, it's all about expectation and knowledge and understanding. I'm a big believer that they're going to garner a lot of trust here moving forward because they're actually going to outperform what the illustrated rates were. And that I can tell you, I'm extremely confident. I'm banking on that for myself. Now, everybody has to come to their own, I guess, perspective on that, right? And you have to do your own research, and you have to, go through your own education. And I would absolutely, never tell you to just take my word for it. But what I will say is that, to me, when you look at this, that line of thinking makes a lot of sense. And, to me, it's actually just common sense when you look at the math behind it all. So, and there's hundreds of years to prove it mathematically, right? Like, so it just is what it is. So anyway, I hope I wanted to share this with you because I think it gives a picture to something that is kind of complicated to a lot of people, and a picture says 1,000 words. I wanted to share this with you because I think it will simplify your understanding of the movement of how whole life dividends follow the current markets and why I think they're going to go back up. And ultimately, when we talk about index universal life versus whole life insurance, index universal life actually suffers in this environment because as that environment goes up, as taxes go up, it's going to put stress on financial markets. So indexes aren't going to perform as well as life insurance companies need in the short term to support the dividend rates. They're going to use index universal life and reduce cap rates and use those as a profit source to be able to back the guaranteed products like whole life insurance. And there's a lot more. I've got videos on that. I'll actually link one of them in the end screen at the end of this video. So if you're interested in learning about index universal life versus whole life insurance, you can go do that. But anyway, if you found value in this video, make sure you hit that subscription button, click the bell, that way you get notified every time I launch a new video. If you have any questions at all, comment in the comment section below. I do my best to engage with every single comment. And as always, until next video, have a blessed, inspirational day. Take care.